Good morning and welcome to the Killik podcast for Friday the 16th of January. This week's been all about the Swiss National Bank, which has removed the currency ceiling on their exchange rate against the euro. They've also cut their interest rates to minus 0.75%. Prior to this, the bank was printing Swiss francs in order to buy euros to keep a lid on that exchange rate and promote the efficacy of their exporters within the country. They've also looking to counteract deflation because a strong currency creates import deflation into the economy. Since 2011, however, we've seen dollar strength against the Swiss franc, which has given them sort of more room to breathe as the sort of safe haven currency and an alternative to the Swiss franc. But we've also seen more divergence in monetary policy. So the ECB are going into a more aggressive phase of monetary easing with their QE program on the 22nd. And that's made the ceiling harder to hold. So they've sort of stepped back from that. Market response was to sell Swiss exporters and upgrade expectations for the QE announcement on the 22nd of January. So that's why European markets went up in response to this. We also saw gold go up because the opportunity cost of holding gold is now lower because the rate you're getting on Swiss francs is lower. In the US, we've had mixed data over the last week. So the jobs number was good, but we didn't see any wage inflation, which is sort of puzzling because if jobs are going up and the availability of labour is diminishing, surely wages should be going up as well. What this chart shows is that actually average hours worked has also gone up. So you're seeing more productivity in the workforce because an underutilised workforce is coming to work. We saw a very disappointing retail sales number this week. So year on year, it's only marginally up. This was somewhat of a surprise because of the weak oil was meant to be feeding into stronger retail sales. Results season starts now. We've had a couple already. They've been sort of mixed. But overall, we think that US results season should be pretty positive because we've seen the sort of decrease in estimates in the oil companies, so that's already in the market, but analysts have been reluctant to upgrade their numbers because of weak oil. So the beneficiaries of weak oil, we hope we'll see beating in this fourth quarter results season, which is coming through now. Just looking at oil, we've read a number of analyst reports recently that comparing today's situation to 1985 in oil. And on this chart, we see the oil price from 74 through to 1990. And as you can see, we saw a very sharp increase in the price of oil in 1979 during the Iranian Revolution and the Iran-Iraq War. Then we went through a period where high oil prices for an extended period prompted a lot of new supply coming onto the market, particularly sort of non-OPEC supply, so North Sea oil, for example. And as a result, OPEC started to lose market share, which is kind of what's been happening recently because of shale. In 1985, they decided enough was enough and they started to increase their production. You saw the oil price absolutely tank on the back of that, and we saw a 50% fall in oil. So where are we today? We're in a sort of similar position, and the company's response to the 85 fall in oil of around 50% was to cut capex. So the integrated majors across the board cut capex for around 25%. Also, the costs within the companies fell dramatically. So rig costs fell from $90,000 a day to $12,000 a day. They shed employees. A lot of redundancies were made. But also on the positive, the refining margins, because the input costs were lower, went up. So net, you saw a very big decrease in the oil price, but operating cash flow was only down around 20%, and actually free cash flow was flat. So as a result, all the majors maintained their dividends, and that's a really important point. So looking at where we are in terms of the oil majors at the moment, you've seen a marked underperformance in the likes of Shell and BP in the UK market over the last few months. And typically, if we go back to 85, 86, those oil companies got to a point where they were yielding twice the market rate. At the moment, we're almost there. Then, about 3 months before oil bottomed, you started to see a rally in these names, and they rallied to around 1.2 times the market yield. So if you look at Shell and BP at the moment, BP is yielding 6.8%, Shell is yielding 6%. We feel that the downside is probably limited around here, providing they hold their dividends. And if you go back to Shell at 1.2 times the market yield, then you're talking 4.5%, which is about a 30% rally from where we are at the moment. Equally, a sort of similar tact, BHP Billiton, which has got a big oil business, is yielding around 6.8%. An interesting note from Goldman Sachs, putting that on their conviction buy list this week, prompted a bit of a rally in the share price yesterday. They're saying that similar to the oil companies, they've got capex flexibility and a strong balance sheet, so they're looking for BHP to hold their dividend. So we got their results on Tuesday, looking at the week ahead. We've also got Unilever, SAP on Tuesday. On Wednesday, we've got Land Securities, eBay in the States, really interesting, American Express. That feeds into a theme that we've been running quite hard on. Thursday, Verizon, and then Friday, we've got McDonald's of note. That's about it there. Actually, we've also got Google reporting next week, which isn't showing up on there. So just looking at Google, ahead of the numbers next week, Google's down 14% from its high, so it has been weak against a generally pretty solid market in the States. We're sort of reviewing that position and think it's probably a good time to be topping up positions in Google. Just looking at the sort of broader picture, here we've got a chart of the US digital media time spent by platform. As you can see here, mobile has now moved to around 60% of the time that people are spending in that space. And you've seen a big structural shift from desktop down to 40 from 53, and mobile up from 47 up to 60. So is Google still relevant in this sort of scenario? We think it very much is. And if you look at the mobile apps in June in the US and the most visited, you've got YouTube number 2, Google Play number 3, Google Search number 4, Google Maps number 6, Gmail number 7. I think that proves the point. So thanks very much for listening.